and welcome to another episode of this special series, Get Started in the Market, where we help you understand the basics of stock market investments. Before we go ahead, here's a quick look of our last episode. In today's episode, we'll tell you the various ways you can invest in equities. You can buy individual stocks from the secondary market, you can invest in the initial public offering of a company at the time of listing, or you can even buy into its follow-on public offering. You have the option of investing through the mutual fund route, and you can also buy into exchange-traded funds or ETFs. A mutual fund is a pool of investments into stocks, bonds, commodities, or a combination of securities which is managed by a professional. ETFs have some common characteristics with both individual stock trading and with buying a mutual fund. A typical ETF tracks an index like an index fund, but is traded on an exchange like a stock. So an ETF is like buying a specific index, but instead of buying each and every stock in an index, you are just buying a single fund, which stands for the underlying stocks in the index. The ringing of this bell changes the status of a company from a private limited company into a public listed one, which means anyone from the public can now bid and buy the stock of this company. Once you decide on the IPO you want to subscribe to, you will need an application form such as this. This form is available online with your broker or even your banker. Every application form has to be set for a minimum number of shares, which you need to submit along with a check for the total amount of shares that you are applying for. Let's start today's episode with the different kind of trading orders that you can use while deciding to buy or sell in the stock market. These are words that you must have heard many times. But what do they really mean? To start with, market order and limit order are different types of orders that you have the option to place while trading in a stock. Let's detail each of them. A market order is when you put in a buy or a sell order and it gets executed immediately. That is, your order goes through immediately at the best available current price. So you don't have to mention the price at which you are bidding. It's an instant go through. The risk of using this option is that the price that you last saw and decided to put in your order and the price at which the order actually goes through might vary. But what do you do if you want to buy a stock only at a specific predetermined price? In this case, you will use the option of a limit order. Let's understand how this works with an example. Supposing you want to buy one share of TCS at a predetermined price of 2,450 rupees, but the current market price of TCS is 2,500 rupees. So what will you do? You will ask your broker to put in your order with a limit price of 2,450 rupees. So if and when the stock touches this price, your order will get executed. But what happens in case the stock does not touch the price that you have put in? In that case, you have the option of modifying your order. So you could revise the same order. In this case, you might choose to revise it upwards to 2,470 rupees in a bid to execute it. These orders are valid only for the same trading day. They do not get carried forward. You can use a similar order when you want to sell a stock by putting a stop loss. The idea of a stop loss is to reduce the amount of loss that you might have to take. Let's take our previous example forward. In case you wanted to sell one TCS stock, which is trading at 2,500 rupees in the market, but you would only like to sell the stock when it has moved a little higher to 2,550 rupees. So you will put in 2,550 as the limit in your sell order. But what happens if the stock, instead of moving up, starts moving further down? Here you have the option of putting in a stop loss, which will limit your losses. So in this case, if you would have put a stop loss of 2,450 rupees, your trade would have gotten executed as soon as the stock would hit the lower limit of 2,450, saving you from any further losses. For more on this, let's go across to Mr. Deven Choksi, MD and CEO of KR Choksi Shares and Securities Private Limited. Thank you very much for joining us. My first question to you is, can you take us through the different types of orders that are most commonly used while trading?
Well, generally, I think when the investor comes, I think investor basically is two different profiles. One is an individual profile and second is an institutional profile. When an individual profile investor comes into the market, generally I think he would like to trade or he would like to invest. The bifurcation is between trade and the investment. And when you talk about the orders are generally, I think, the open market orders or the limit orders. Normally it is seen that investors, when he places his order, particularly I think for investment purpose, he would like to, I think, put across some amount of limit or the target for which I think he wants to buy or sell, as the case may be. When he gets into the trading, he actually, I think, gets into the trading with a little bit, I think, better quality order, in the sense that he would not only put across the limit for buying and selling, but he would also put across the stop losses. So different types of order in the system. The subject is a bit technical for individuals, but I would simplify and say that I think individual investors either places a limit order for investment and limit order and stop loss orders for trading purpose.
So are there any risks associated with placing these orders?
Oh well, yes, I think there is an element of risk. Normally, I think in the industry, the orders are executed by the trained dealers. Nowadays, with the online trading, the investors also execute the orders themselves. Whether the dealer executes or an investor executes, there is one fundamental risk which remains into the system, that if the trade or the order is passed into the system, and if you have made an error in punching, which we generally call it the fat finger error, that could possibly result into a kind of a losses to the customer or the investor if it is not properly done. So for sure, I think there is a risk into that. Similar way, I think you have to have the compliance part managed. The exchanges and the regulators have stipulated certain norms that before the buying takes place, I think investors should have paid the margin. Particularly in the trading segment, I think the margin is must. Similar way, I think when you are entering into the cash market, you also have to have the stock, the delivery of the stock, if you particularly want to sell the stock. Without having stock in your portfolio, if you sell, then it is not treated as a normal order. I think it is subject to some amount of regulatory requirements. Most of the trading applications, including online trading applications provided by the broker through their front ends, they are quite sophisticated today. So to a greater extent, I think they prevent, I think, such kind of errors to take place, because from the risk management system they would have provided certain limits. So beyond that limit, I think your trades won't get executed. So as a result of which, I think you don't run that unlimited risk. You have to have some amount of expertise, as I would call it, to execute your orders and trades.
So keeping these risks in mind that you just spoke about, are there any thumb rules that you would say that investors should follow while punching in their trade?
Sure. First, while buying, you must keep a set of margin with you. Without that margin, you should not be going for the buying orders. Same way for selling, a simple thumb rule that you should be keeping, you should have stock in your portfolio, in your demat account. If you don't have in your demat account that particular stock, you should not enter into selling that particular stock. At the same time, I think the exchanges have prescribed different kind of segments. Typically, I think those segments where the delivery is compulsory, they call it T2T segment, trade to trade segment. That is also required to be known by the investor if he is particularly trading online. If the broker dealer trades on his behalf, then he is supposed to know this particular aspect. Of course, in the risk management system of the broker, this particular aspect is programmed. So to a greater extent, I think it will even give you an alert or warning before a trade takes place. So to a greater extent, I think the investor would know that aspect well. These are some of the things which he needs to look into while punching in the transactions into the system.
In terms of the charge structure, are there different charge structures that brokerages adopt with respect to different orders?
Fortunately or unfortunately, answer is yes.
Okay.
Why I said fortunately? Because I think we have different sets of customers. We have different sets of volume generated by the customers, and we have the delivery based transaction and non-delivery based transactions. Generally, in case of delivery based transaction, the charges are on a higher side. In a non-delivery based transaction, the charges are on the lower side. At the same time, I think your charge structure also depends on the volume that you contribute to the brokerage. If you are a big volume player in the market, then the brokerage would end up giving you discounted rate of the brokerage. Unfortunate it is more because I think it's a cats and dog war in this brokerage industry, wherein I think brokerages, they lure customers into the prey by giving them discounted rate of brokerage, and most of the time the customer would end up trading far more beyond his capacity because he has been given discounted charges. So we say that investor must, like they say that I think buyers beware. Likewise, I think investor must be aware about these issues, that they must not fall into this prey.
So what are the important things that an investor should ask a broker before beginning trading in the market?
See, first and foremost, I think he should ask all the KYC information very properly, whether the broker has collected all this information from you, because it's a regulatory requirement. Second thing, he should be very clear about, I think, what are his obligations, when he has to make the payment, when he has to receive the payment. Should ask very clearly. For any value-added services that he is asking for from the brokers, an investor cannot pretend that I was not aware about it. He should ask for those value-added services. They are available. And those value-added services which he is availing from the brokerages, he has to offer the charges to the broker. Even if broker says, you know, I will give you at a discounted rate, still investor in his own interest, I think, should offer him a charge. Okay, I am availing a value-added services from, say for example, research. Say for example, timely calls on buying and selling side. If an investor is asking for all these services, he better pay price for it. Because otherwise an intermediary or the broker would start losing his interest in the investor over a period of time.
And finally, what is your advice to first-time investors entering the stock markets?
A simple advice is that please study your subject well. If you do not know enough about equity, make an attempt to study equity first. There are various intermediaries who are interested in educating you. Stock Exchange and the SEBI also conducts program from time to time, and they have on their site lot of material available. At the same time, the brokerages and the intermediaries are available who can actually help you in understanding this subject. But more importantly, before you get into the market as an investor, your job should be to know what exactly your purpose of investing is. If your purpose of investing is for long term, then accordingly I think you should take the information from the brokerages on the companies that they are recommending and selectively buy those companies into the portfolio. It is a complex subject, mind well. Not every investor is proficient with the understanding aspect of this subject. Our recommendation to make things simple for them is that, like you consult your family doctor, you start consulting your financial doctor. If you want to be a successful investor, I think you must spend time to understand this kind of a subject. Read as much as you can, understand as much as you can. Simply don't look at TV tickers and start trading into the market. That's a caution message that I would like to put it across.
All right. Thank you very much for joining us.
Thank you.
Now that we know how to punch in our trades, let's get down to knowing how to ensure that our trades have actually gone through the way we ordered. For this, there is a simple tool on the National Stock Exchange website. All you need to do is go to the Verify Your Trade section and type in your username and password, and you will get a list of all the trades taken place in the last 10 days. Remember that the data for these trades is only available for the past 10 days of the last trade that you carried out. In addition to this, the National Stock Exchange will also send you email and SMS notifications like this one, confirming all your transactions.
When an investor places order, he does through broker. And for the transactions that are done for him, broker issues a contract note. And these days, because of the technological advancement, brokers also give you an access on their site, or they send you a digital contract note. But apart from this information that comes to you from the broker, if you want to independently examine whether what is sent to you is correct or not, has somebody at the last mile changed, or has somebody worked on the contract note, has it been tampered, or you are a member, you are an investor, you are traveling somewhere and you are not able to access your mailbox for some reason, or you are dealing through so many brokers that you don't want the hassle of going through each contract note by contract note, then I think best facility that you can make use of is the trade verification facility on the NSE website. What you have to do is simply come and register on our site, leave your email and leave your mobile. We'll make sure that you receive SMS at the end of the day, you receive an email. Apart from that, you can log on to our site, and from there you can check transactions for past 10 days in your account, so that you will get a single view of all the transactions that have happened on the NSE.
Within 24 hours of your trade, you should receive a contract note from your broker like this one. These contract notes are usually in a digital form. So make sure you have a verified email account. This is proof of your trade. You can ensure there is no variation in your trades by cross-checking here. It will have details of your broker and your Demat account, the order number of your trade, the time and date when the order was punched in, with the time when the trade actually went through, the name of the security you traded along with the quantity, and the price that you bought or sold the security at. The note will also detail the brokerage that will be charged to you along with the service tax, giving you the net amount that you are obligated to receive or pay. Always ensure that this contract note is signed by an authorized signatory. In case there is any discrepancy, or if the shares that you have bought or sold are not reflecting in your Demat account, but the money has been debited, approach your broker immediately. This has to be done within 10 days from the transaction date. In case the broker does not give you a satisfactory response, approach the investor cell of the stock exchange within 15 days from the transaction date. So here is a quick checklist of what you need to keep in mind. Make sure you receive the contract notes within 24 hours of your trade. Review the transactions in your Demat account regularly. Ensure that the securities movement in your Demat account is valid. Make sure that the funds that are being transacted are from the trading member's account only. And make sure that the payments to the broker are by account payee checks, demand draft or pay order. While online trading is the most convenient way to trade, there is a possibility of a systems failure due to network or connectivity issues. In such a case, what can you do? Can your broker complete the trade? For more on this, we are joined by Mr. Amrish Baliga. Thanks very much for joining us, sir. My first question to you is that since the entire trading system is technologically driven, what are the backup systems in place in case of any kind of failure on part of the brokerages?
See, generally the brokers and the exchange has an extremely robust system, and this goes through regular audits. So the chances of the system going down are quite minimal. But yes, we have seen systems going down, and at the same time we have seen that the exchanges also have handled it extremely well with the minimal losses to the investors.
If there is any mistake been made while entering in the trade, or if the investor wants to reverse or modify the trade, is there any possibility to do this?
The broker generally has a couple of backups. For example, it is very much possible that the systems in one office or a branch office or even the head office can go under. In case it goes under, you can always access the exchange through another branch office. If all the branch offices are down, they can still go to the exchange and operate their code from the exchange itself.
For a first-time investor, what should one keep in mind? What are the most important things, and also what should one ask one's broker?
No, first of all, he should go to a broker only through reference, unless of course it's a very well-known brand. And at the same time, he should also check out whether the broker is able to serve his requirements. It's not necessary that just because it's a great brand means that it could be the right fit for your requirement. Because a number of times I've seen that a small investor requires a lot of coaching, and it's possible that a large brand may not be able to give him that attention and time, whereas a smaller broker, even a sub-broker at times, is able to serve him better.
Before we end this week's episode, here are some lesser-known facts. Did you know that brokerage charges are negotiable? There is no minimum brokerage that is prescribed by the exchanges. However, the maximum brokerage that can be charged is 2.5% of the contract value. If your complaint does not get resolved with the exchange's investor cell, you can choose the arbitration mechanism. This is a quasi-judicial process aimed at a quicker resolution of disputes. With that, it's a wrap on this episode of Get Started in the Market. We'll be back next week with our final episode of this series. Thanks for watching.